Hey everyone, Chad Pavel, CPA here. The big question I often get from first-time entrepreneurs very often is, how do I pay myself and how do I pay taxes on a single member LLC? All right, so if this is your first time opening a business, if you've never run an LLC before, you've never had a tax return, and you're just thinking about how do I actually pay myself and how do I make sure that I'm keeping track of all the profit and loss, how do I pay taxes, I don't want to have penalties and interest, how do I stay on top of all of this stuff? So you're definitely asking yourself the right question. So what I've done is I've created a quick little whiteboard presentation where I'm going to show you what it really takes to first track your profit and losses within an LLC, and then second, how your income actually carries over to your tax return, and then number three, how to actually pay taxes on your LLC profits. All right, so as you can see, we've got a blank slate right here, and what we're going to do is we're just going to assume that you are an owner, a 100% owner of a single member LLC, and that you live here in the United States. If you've got multiple members, if you have, if you live outside of the US, if you own multiple LLCs, this will certainly get more complex. But just to make things very simple, again, we have one US individual and you own 100% of an LLC. All right, so that's really just what we need to start with. So I'm just going to create the LLC entity basically, and that's going to be called Yourco. So Yourco LLC, and obviously we need to put you up here. So let's put you as the single owner. So you own 100%, and you're happy because you own a very awesome, profitable business. So you own 100% again of this LLC. So let's again assume that you've been in business. This is going to be a business that's been going for, let's say, a year. Let's say you started it in February or March, and now it's December, and you have concluded the business operation. So let's just talk about how to make some money. So we're going to actually show you making money. Let's say you did $200,000 in revenues or sales, same thing. All right, so you got $200,000 going into the business, and let's say that you have spent $100,000 to run the business. So you've got $100,000 in business deductions, expenses, whatever you want to call them. So obviously the big simple math here is 200 minus 100. You've got $100,000 in taxable profit. Put that in green. So you made $100,000 on this business this year. First of all, it's a pretty darn good number, especially for your first year in business. And so you've got $100,000 in profit. So the first thing to note is, how do I pay myself? Well, as a single member LLC owner, there's really only one way to pay yourself, and that is you take money out of the business bank account and you write yourself a check, you send yourself an ACH or a Venmo or really anything to get the money out of the LLC's business bank account. That's it. That is how you pay yourself. There's no additional tax on you taking money out of a single member LLC. It's actually taxed the same way as a sole proprietorship, in the sense that, again, all you really are doing is taking money out of the business bank account and writing yourself a check. Now, there are some things to consider here. Obviously, you got to make sure there's enough money in the bank account. And so the question really then is, well, whether I take $20,000 out or maybe I take all $100,000 of my profits out, what am I going to pay taxes on? So that's the second thing. But again, number one is you simply write a check. And that's how you pay yourself, and you call that a draw. So there's really no payroll. You're not taking a paid check. You're not writing yourself a 1099. There's no guaranteed payments, as we call them, in partnership or multi-member LLC land. But if you're a single member LLC owner, you simply write yourself a check for how much money you need. And you'll get an idea of how much you need to live on after you get the business really rocking and rolling. But that's as simple as it can be. The second thing is how you pay taxes. Well, you're going to pay taxes on the business's profits. All right. So it's as simple as that. You're going to pay taxes on your business profits. And here's the other caveat. Regardless of how much money you take out of your single member LLC in the form of salary or draw, we'll call it a draw, regardless of how much you take out, you're still going to pay tax on the profits. And the profits of the business we just calculated are $100,000. So here's how that works. Let's move over to the right a little bit. On your individual tax return, or your married filing jointly tax return, which is your Form 1040, if you take a look at it right now, you're going to see a couple of different things. You're going to see wages, you're going to see other income, you're going to see all sorts of different inputs. But basically, you're going to have a separate schedule, and it's called a Schedule C. And you're going to have a Schedule C for every single member LLC or sole proprietorship enterprise that you have going on in your life. So a different Schedule C. So in this Schedule C, this is a Schedule C, you're going to have a profit and loss statement. It's going to show various details of your $200,000 in income, and you're going to have various details of your $100,000 in expenses. But in the end, it's going to show a $100,000 profit. All right, now here is how you pay taxes on that $100,000 profit. On your individual tax return, you're going to have this Schedule C, but basically you're going to have all of this carry forward over, and it's going to have a line item for $100,000 for income from your business, basically. And so that is going to be part of your taxable income, your $100,000. Now, let's say that you are married and you also have a day job. Let's say this was just a side hustle. Well, you're going to have income from your job. You're going to have wages and salaries. So let's say that you have $100,000 also from your day job. Let's say your spouse makes $125,000. So you're going to have 100 plus 125, which is 225 in wages on your tax return. You're going to have $100,000 in business income. We'll call it Schedule C income. And on this income, you're probably not going to have taxes withheld. The way you actually need to make sure you pay enough tax is that you account for the income you're going to have and you make some estimated tax payments. So basically, in a nutshell, as simply as possible, your inputs, or the money in your income, is going to be the combination of you and your spouse's, if you're married, wages from day jobs, and then all of your earnings from your various LLC ownerships. And again, in this case, it's really simple. It's a single member LLC that you own. You and your spouse make $225 in wages. The business made $100,000 in income. So on its simplest level, you're going to pay tax not just on the $225, and hopefully you've taken out enough on your salaries, but you're going to have also the $100,000. So your income tax return is going to show total income of $325,000. Now, of course, there's all sorts of deductions and credits and other things that you're going to have that will very likely reduce your taxable income. But in the end, that is how you pay tax on a single member LLC. You make money in your business, it carries over to your tax return, and on your individual tax return, you will pay taxes. There is no tax, federal tax. You do not pay federal income tax from the LLC. The LLC does not own it because this income is called pass-through income. The income and the losses you make on a Schedule C, which is a single member LLC tax form, carries over to your individual tax return. It passes through, and you pay any additional tax that you owe on that income. Now, obviously, what you want to do is make estimated tax payments throughout the year on your estimated profits. And there's a couple different ways that you can get that very, very accurate. Otherwise, you'll pay penalties and interest at the end of the year if you had income that you did not pay tax on. So hopefully this was helpful. This is how you are taxed on a single member LLC, and this is also how you pay yourself. You simply write checks to yourself for a couple $1,000 a month, $5,000, $10,000 a month, once a year, doesn't really matter. That is how you pay yourself. All right, everyone, hopefully that was helpful. If you're thinking about forming a new business, just know that LLC taxation in the US as an individual 100% owner is actually quite simple. You simply pay taxes on the profits of your LLC on your Form Schedule C, which is a part of your Form 1040 or individual tax return, whether it's you as a single person or married filing jointly or with your kids as dependents also. It's the same exact thing. It's just an extra schedule that shows how much income your business made. So obviously, it's important to keep track of your profit and loss throughout the year, to make estimated tax payments if you want to avoid penalties and interest, and most importantly, to plan for the additional income so that you can reduce that income, you can maximize your tax deductions, and pay the least amount of tax legally available to you. Again, I'm Chad Pavel. Check us out at our website below. Subscribe to the channel here. Look forward to helping you in the next video.